Copyright disclaimer. Under Section 107 of the Copyright Act 1976, allowance is made for fair use for purposes such as criticism, comment, news reporting, teaching, scholarship, education and research. Fair use is a use permitted by copyright statute that might otherwise be infringing. Welcomes to Chartered Accountant Channel. Today taking about Chapter, Theoretical Framework. Unit 2, Accounting Concepts, Principles, and Conventions. Video No. 8. Accounting Concepts, Principles, and Conventions. Introduction. Let us imagine a situation where you are a proprietor and you take copies of your books of account to 5 different accountants. You ask them to prepare the financial statements on the basis of the above records and to calculate the profits of the business for the year. After few days, they are ready with the financial statements and all the 5 accountants have calculated 5 different amounts of profits and that too with very wide variations among them. Guess in such a situation what impact would it leave on you about accounting profession? To avoid this, a generally accepted set of rules have been developed. This generally accepted set of rules provides unity of understanding and unity of approach in the practice of accounting and also in better preparation and presentation of the financial statements. Accounting is a language of the business. Financial statements prepared by the accountant communicate financial information to the various stakeholders for decision-making purpose. Therefore, it is important that financial statements prepared by different organizations should be prepared on uniform basis. Also, there should be consistency over a period of time in the preparation of these financial statements. If every accountant starts following his own norms and notions for accounting of different items, then there will be an utter confusion. To avoid confusion and to achieve uniformity, accounting process is applied within the conceptual framework of generally accepted accounting principles, GAAPs. The term GAAPs is used to describe rules developed for the preparation of the financial statements and are called concepts, conventions, postulates, principles, etc. These GAAPs are the backbone of the accounting information system, without which the whole system cannot even stand erectly. These principles are the ground rules, which define the parameters and constraints within which accounting reports are generated. Accounting principles are basic norms and assumptions on which the whole accounting system has been developed and established. Accountant also adheres to various accounting standards issued by the regulatory authority for the standardization of accounting policies to be followed under specific circumstances. These conceptual frameworks, GAAPs, and accounting standards are considered as the theory base of accounting. Accounting concepts. Accounting concepts define the assumptions on the basis of which financial statements of a business entity are prepared. Certain concepts are perceived, assumed, and accepted in accounting to provide a unifying structure and internal logic to accounting process. The word concept means idea or notion, which has universal application. Financial transactions are interpreted in the light of the concepts, which govern accounting methods. Concepts are those basic assumptions and conditions, which form the basis upon which the accountancy has been laid. Unlike physical science, accounting concepts are only result of broad consensus. These accounting concepts lay the foundation on the basis of which the accounting principles are formulated. Accounting principles. Accounting principles are a body of doctrines commonly associated with the theory and procedures of accounting, serving as an explanation of current practices and as a guide for selection of conventions or procedures where alternatives exist. Accounting principles must satisfy the following conditions. 1. They should be based on real assumptions. 2. They must be simple, understandable, and explanatory. 3. They must be followed consistently. 4. They should be able to reflect future predictions. 5. They should be informational for the users. Accounting conventions. Accounting conventions emerge out of accounting practices, commonly known as accounting principles, adopted by various organizations over a period of time. These conventions are derived by usage and practice. The accountancy bodies of the world may change any of the convention to improve the quality of accounting information. Accounting conventions need not have universal application. In the study material, the terms accounting concepts, accounting principles and accounting conventions have been used interchangeably to mean those basic points of agreement on which financial accounting theory and practice are founded. Concepts, principles, and conventions, an overview. Now we shall study in detail the various accounting concepts on which accounting is based. The following are the widely accepted accounting concepts. A. Entity concept. Entity concept states that business enterprise is a separate identity apart from its owner. Accountants should treat a business as distinct from its owner. Business transactions are recorded in the business books of accounts and owner's transactions in his personal books of accounts. The practice of distinguishing the affairs of the business from the personal affairs of the owners originated only in the early days of the double-entry bookkeeping. This concept helps in keeping business affairs free from the influence of the personal affairs of the owner. This basic concept is applied to all the organizations, whether sole proprietorship or partnership or corporate entities. Entity concept means that the enterprise is liable to the owner for capital investment made by the owner. Since the owner invested capital, which is also called risk capital, he has claim on the profit of the enterprise. A portion of profit which is apportioned to the owner and is immediately payable becomes current liability in the case of corporate entities. Example: Mr. X started business investing 7,00,000 with which he purchased machinery for 5,00,000 and maintained the balance in hand. The financial position of the will be as follows. Capital 7,00,000 machinery 5,00,000 cash 2,00,000. This means that the enterprise owes to Mr. X 7,00,000. Now if Mr. X spends 5,000 to meet his family expenses from the business fund, then it should not be taken as business expenses and would be charged to his capital account, i.e., his investment would be reduced by 5,000. Following the entity concept, the revised financial position would be capital 7,00,000 less, drawings, 5,000, 6,95,000 machinery 5,00,000 cash 1,95,000. B. Money measurement concept. As per this concept, only those transactions, which can be measured in terms of money, are recorded. Since money is the medium of exchange and the standard of economic value, this concept requires that those transactions alone that are capable of being measured in terms of money be only to be recorded in the books of accounts. Transactions, even if they affect the results of the business materially, are not recorded if they are not convertible in monetary terms. Transactions and events that cannot be expressed in terms of money are not recorded in the business books. For example, employees of the organization are, no doubt, the assets of the organizations, but their measurement in monetary terms is not possible, therefore, not included in the books of account of the organization. Measuring unit for money is taken as the currency of the ruling country, i.e., the ruling currency of a country provides a common denomination for the value of material objects. It may be mentioned that when transactions occur across the boundary of a country, one may see many currencies. Suppose a businessman sells goods worth 50 lakhs at home and he also sells goods worth of 1 lakh euro in the United States. What is his total sales? 50 lakhs plus 1 lakh euro. These are not amenable to even arithmetic treatment. So transactions are to be recorded at uniform monetary unit, i.e. in one currency. Suppose euro 1 equals 71. Total sales equals 50 lakhs plus 71 lakhs equals 121 lakhs. Money measurement concept imparts the essential flexibility for measurement and interpretation of accounting data. This concept ignores that money is an inelastic yardstick for measurement, as it is based on the implicit assumption that purchasing power of the money is not of sufficient importance as to require adjustment. Also, many material transactions and events are not recorded in the books of accounts just because they cannot be measured in monetary terms. Therefore, it is recognized by all the accountants that this concept has its own limitations and inadequacies. Yet it is used for accounting purposes because it is not possible to adopt a better measurement scale. Entity and money measurement are viewed as the basic concepts on which other procedural concepts hinge. C. Periodicity concept. This is also called the concept of definite accounting period. As per going concern concept, an indefinite life of the entity is assumed. For a business entity, it causes inconvenience to measure performance achieved by the entity in the ordinary course of business. If a textile mill lasts for 100 years, it is not desirable to measure its performance as well as financial position only at the end of its life. So a small but workable fraction of time is chosen out of infinite life cycle of the business entity for measuring performance and looking at the financial position. Generally, 1-year period is taken up for performance measurement and appraisal of financial position. However, it may also be 6 months or 9 months or 15 months. According to this concept, accounts should be prepared after every period and not at the end of the life of the entity. Usually this period is 1 calendar year. We generally follow from April 1st of a year to March 31st of the immediately following year. Thus, for performance appraisal, it is not necessary to look into the revenue and expenses of an unduly long time frame. This concept makes the accounting system workable and the term accrual meaningful. If one thinks of indefinite time frame, nothing will accrue. There cannot be unpaid expenses and non-receipt of revenue. Accrued expenses or accrued revenue is only with reference to a finite time frame, which is called accounting period. Thus, the periodicity concept facilitates in I. Comparing of financial statements of different periods, 2. Uniform and consistent accounting treatment for ascertaining the profit and assets of the business, 3. Matching periodic revenues with expenses for getting correct results of the business operations. D. Accrual concept. Under accrual concept, the effects of transactions and other events are recognized on mercantile basis, i.e., when they occur, and not as cash or a cash equivalent is received or paid, and they are recorded in the accounting records and reported in the financial statements of the periods to which they relate. Financial statements prepared on the accrual basis inform users not only of past events involving the payment and receipt of cash but also of obligations to pay cash in the future and of resources that represent cash to be received in the future. To understand accrual assumption, knowledge of revenues and expenses is required. Revenue is the gross inflow of cash, receivables, and other consideration arising in the course of the ordinary activities of an enterprise from sale of goods, from rendering services and from the use by others of enterprise's resources yielding interest, royalties, and dividends. For example, 1. Mr. X started a cloth merchandising. He invested 50,000, bought merchandise worth 50,000. He sold such merchandise for 60,000. Customers paid him 50,000 cash and assure him to pay 10,000 shortly. His revenue is 60,000. It arose in the ordinary course of cloth business. Mr. X received 50,000 in cash and 10,000 by way of receivables. Take another example. 2. An electricity supply undertaking supplies electricity spending 16,00,000 for fuel and wages and collects electricity bill in 1 month 20,000,000 by way of electricity charges. This is also revenue which arose from rendering services. Lastly, 3. Mr. A invested 1,00,000 in a business. He purchased a machine paying 1,00,000. He rented it for 20,000 annually to Mr. B. 20,000 is the revenue of Mr. A. It arose from the use PG the enterprise's resources. Expense is a cost relating to the operations of an accounting period or to the revenue earned during the period or the benefits of which do not extend beyond that period. In the first example, Mr. X spent 50,000 to buy the merchandise. It is the expense of generating revenue of 60,000. In the second instance 16,00,000 are the expenses. Also, whenever any asset is used, it has a finite life to generate benefit. Suppose, the machine purchased by Mr. A in the third example will last for 10 years only. Then 10,000 is the expense every year relating to the cost of machinery. Accrual means recognition of revenue and costs as they are earned or incurred and not as money is received or paid. The accrual concept relates to measurement of income, identifying assets and liabilities. Example, Mr. JD buys clothing of 50,000 paying cash 20,000 and sells at 60,000 of which customers paid only 50,000. His revenue is 60,000, not 50,000 cash received. Expense, i.e., cost incurred for the revenue, is 50,000, not 20,000 cash paid. So the accrual concept-based profit is 10,000, revenue, expenses. As per accrual concept, revenue, expenses equals profit. Accrual concept provides the foundation on which the structure of present-day accounting has been developed. Alternative as per cash basis: cash received in ordinary course of business, cash paid in ordinary course of business equals profit. Timing of revenue and expense booking could be different from cash receipt or paid. When cash received before revenue is booked, a liability is created when cash is received in advance. 2. When cash received after revenue is booked, an asset called trade receivables is created. 3. When cash paid before expense is booked creates an asset called trade advance when cash is paid in advance. 4. When cash paid after expense is booked creates a liability called payables or trade payables or outstanding liabilities. Thank for watching. Follow videos and learn more.